How are you doing? This is David W. Williams, also known as Diamond Dave, and we're going to go into the Peloton play. And this is just going to be another one of the capstone courses. So we did the walkthrough. We still got the Rite Aid play. Now we got the Peloton play. We'll probably add something a little bit later, probably maybe third or fourth quarter this year. Let's see how it goes. But we're going to just keep adding to this because I want to really show you how to really thoroughly look at a play, analyze it from a lot of different angles, come up with a bull and a bear case, and kind of understand whether or not it's a great opportunity for you to try to look at it with options, right? Or maybe just disregard it. Therefore, you can spend time researching something. It doesn't mean that you should play it just because you researched it. It means that you can research it and everything could be a green light except maybe the options chain. Okay, I see a lot of plays like that. Or you can research it and you may feel like, well, you know what, there's still some uncertainty based on the direction of the play. And if I'm looking to play this from a long-term standpoint, that's going to be a lot less, I'm not as certain, but maybe I may try to do a shorter term play or vice versa. You may like it, not like it short term or like it long term. It all depends on the play. But what I'm going to kind of really show you is that how I was able to analyze this particular play. And I looked at Peloton for pretty much, I want to say the middle part of 2020, right after the pandemic started. And anybody that was following me on social media, but especially on Facebook, knows that I was looking at this play because I kept speaking about it. I spent a lot of time observing this company. And one of the things I really want to get you to understand is that you have to be successful in this market, you really got to dedicate yourself to the study and the analyzing of a situation. Traders are really good analyzers, right? They just don't trade. It's not just about the computer. It's not just about the technical analysis, in my opinion. It's not just about what button you click on the program, right? And then eventually we're going to get computers to do all that anyway. I tell people what's going to differentiate you in this market is your ability to understand the situation. Your brain is what's going to make you different because everything else is going to get automated out anyway. Therefore, your ability to look at a scenario and be able to analyze it is where you're going to really set yourself apart from the pack. And so I would encourage you to keep working through a process of analyzing it as long as it takes you, and to continue to develop your critical thinking ability, not based on what somebody else tells you, but what you believe, the information that is being presented, your interpretation of the information, not, I don't want to do the work, so I'm going to ask somebody else what this information means. Then therefore, you're depending on their ability to analyze as opposed to yours. Now, you can get to that level where you got a team of analysts. However, as of right now, I want you to really develop your skills, because even if you get to a level where you have a team of analysts, you need to have your own understanding so you can kind of determine whether or not they're telling you something that makes sense to you. Let's go ahead and get into it. Now, what we're looking at is the particular options contracts, and we're looking at the result of the play. So we see that this particular put contract was bought on July 15th, Thursday of 2021, and it was sold on November 11th, 2021. So we came in at 11:45 and we came out at 5:30. So that's a 340% ROI. Now, in retrospect, I should have put more on this play. And I'm learning now to focus on a lot the easier plays as opposed to the plays that are really complicated. That's something I talked about before. This was an easy play because I had studied this company for so long. I was very confident of where this was going to go, not based on me forecasting, not really based on me guessing, because of where they were going as a business and me understanding what people are buying when you're investing in a company. And we're going to kind of go into that. So this could have been I should have made this into a $15,000 return, right? With a maybe $3,500 investment. But like I said, as I was kind of scattered when I did this, and I'm learning not to be that way. And I'm learning to plays that I have a really, really high conviction on, that I've spent a lot of time analyzing, that are easy plays. Because one thing about this particular contract, the options chain was very, very liquid. This company does a lot of volume on the daily, does a few million on the daily. The options chain was very liquid. This was a very easy play. There was not a cult behind this particular ticker. There was a lot of green lights in which I probably should have put more money. But, you know, you live and learn as you trade longer. You spend more time in the market. You get better and better at understanding what's going on. Let's get into what we're going to talk about. So the goal of this module is to help you understand how to fundamentally analyze a company and potentially play with options contracts. The key word is potentially. Doesn't mean that you do it. Many of us will feel like, you know what? I've spent, 10 hours studying this company. I've spent the last 3 months or 6 months looking at it. That justifies me doing something. No, it doesn't. Just like if you're going to invest in a company long term, you may spend, 50 hours looking at a company. Just because you spent the 50 hours don't mean you buy the stock. It just means that you have a better understanding of that company. You may buy later. Doesn't mean that you have to buy right now. And you going through a process of understanding how to analyze only makes you better at it. Why? Because this is what you're going to continue to have to do. And this is what a lot of people don't understand. A lot of people are still looking for the quick result in something. And that's the problem, is that instead of investing in the skill set, investing in the process to get good at it, to get the result, I need a quick result. We talked about before. I watched this company literally for over a year because I started watching it right after the pandemic. So let's go back to the last slide. I started watching this company right after the pandemic. I did not buy this put contract until over a year later, July 15th, 2021. I started watching this company, I want to say maybe in April or May. So pretty much almost a year before I bought this contract. And I just kept observing it, and I kept observing it, and I kept observing it, because I was very confident of what I was looking at, and had a lot to do with a lot of different reasons. So what we're going to talk about is, what is the Peloton business model? We're going to talk about what happened pre-2020. We're going to talk about what happened in 2020. We're going to talk about why I was bearish on Peloton long term. We're going to also go into the bull case, because you need both. And then we're going to go into like a conclusion, right? And what I want to show you is the chart. Now, this is the chart of Peloton. This is the chart from their IPO to where we're currently at now. And we're in December of 2021. And we're looking at the chart. They're almost at their IPO price. And so what it took was around 3 years for them to get almost back to their IPO price. We see them come out, and we see around the pandemic, mid to late 2020, we see a slight sell-off. They get under the IPO price. And then we see them really come out of that hole really, really hard. We see them get to around 125. They sold back down to around 100. They went back up to 150. They traded sideways a little bit. They went all the way back down, sold back down off to 100, got back up to 125 again, right? Got back up to 125, and then sold all the way back down to 38.50. And so you really want to understand that this chart started breaking down under 150. We started seeing a lot of price rejection under 150, and there's a reason for that. It's not just something that's happening randomly. When they got around 150, we're starting to see a lot of price rejection at that particular price point. But they came out from, I want to say, around 20 something dollars around April of 2020. And literally by the end of that year, they were already at 150, and they started getting rejected at that price. They got rejected all the way down to around 100. People bought into it. They got to 125, and they got rejected back down again. So what the market is telling us is that it didn't want it at 150. Then based on market conditions, it didn't want it at 125. And then we're seeing big sell-off on the weekly candles. Okay, so I want people to really understand this. So now what we're going to start doing is we're going to kind of go into the pieces of this particular company. But this is the kind of work that I want to really encourage you to do. Now, what did I do? I really identified first on the chart where the resistance was at. Okay, and many people kind of overlook that. So they'll be bullish or bearish on a company, and they may not have identified support and resistance points. So looking at this chart off the top, where am I? I'm not seeing a lot of support, and that's one of the things that you see with a lot of these pandemic plays. They ran up so fast, there is no support. So the problem is when they start to sell down, there is no price point to where you start seeing a lot of consistent demand or what we call a lot of consolidation of price. What we're seeing with this particular ticker is that because of the market, they ran up really, really hard to 125. Okay. You don't see any really price consolidation until around 150. Then you see a little bit of price consolidation in a range between 100 and maybe 125. And then when the market decided that, it is still overpriced, it started to sell down really hard off that 100. You understand me? So you want to sometimes identify this, especially as a swing trader. Where is your support and resistance? And we talked about this in earlier modules, right? Because what we're seeing is supply and demand. Okay. And we're going to kind of talk about that because this company has had several dilution events where they issued out more shares, which means what? They increase the supply of shares. That has a lot to sometimes do with the price selling off. Okay. But I want you to really understand that. So now what we're going to kind of do is go into more of the business model, some of the technicals. When I say technicals, I mean the financial stuff, things of that particular nature. All right, let's get into it. Let's look at the Peloton business model. Now, Peloton presents themselves as a fitness company. But in reality, what they really were to me, and something that the CEO talked about, was a media platform. And to me, when I looked at what they were selling, their model was to get you to buy the front end content. To get you to buy the front end product. Then to drive you into the media platform, which was a subscription based revenue. And so you bought a product up front that got you into like the Peloton universe. And then you paid a subscription to get their media content where they had their classes. And then they continue to get that subscription revenue out of time. So they get the upfront money on the product, but their lifetime value of the customer comes from you staying in the subscription plan. So what we're looking at is, what is the average order value? Then what is the lifetime value, right? Because we understand that is what we're going to use to determine what we can pay from a marketing standpoint to get customers. Then also you got to look at what's the attrition rate. So if we bring somebody into this particular universe and they're paying monthly, how long do we keep them? Because that also impacts how much we can pay to acquire them. So when you're looking at a business that's constructed this way, what you want to look at is what is the average order value? What do I mean by that? When a person comes into the business, on average, what do they spend? Then what you also want to look at is that if we have a subscription model, which increases revenue from that particular customer, once they come in and we bring them into the subscription model, how long do they stay? Because those numbers determine how much we can pay from a marketing standpoint to get the customer. Why is that case? Because if I understand that, you know what, I'm bringing somebody into this business, but they're only staying 3 months. I can only spend so much money to acquire them using a marketing cost than if I was bringing them into the business and they're staying 2 years, because I have a long, what we call back end, or also lifetime value. These are the things that you want to understand when you're looking at these type of companies. OK, also, when you're looking at the fitness space, fitness is seasonal. What do we mean by that? If we look at most fitness companies, but also most diet companies like Weight Watchers, they normally drive a lot of revenue a certain time of the year. This is historical. OK, and I would encourage you to look this up. They normally drive a lot of revenue a certain time of the year where people become more fitness oriented. And then also certain times of the year where people are less fitness oriented, that revenue normally drops off. Therefore, when I'm looking at Peloton, until they prove me different, I'm going to believe they're going to operate on that same type of fitness trend. Also, most fitness trends, right, are here today, gone tomorrow. What do I mean by that? You create a fitness offer. It does really well. A lot of people run to it. They get tired of it. They go do something different. So one thing about the fitness space is people are constantly reinventing their offers. They're constantly trying to refresh their offers. Why? Because you're dealing with the average fitness consumer. The reason why they're in the market is because they're not successful. One of the reasons why they're not successful is because they're not consistent. Therefore, they'll buy your product because it's the hot thing now, and in 6 months, they'll go do something different. That's just how fitness works. This is before Peloton. So the only way Peloton can get out of some of these paradigms is to have something so revolutionary, something so transformative that they change the habit of the customer, because Peloton is going after the average fitness customer. Peloton is not going after elite athletes. That's not where the scale is at. The scale is going after the average fitness customer that is really unsuccessful. So we got to add this into how these things are going to impact their model. Now let's go into what their model looks like on paper. At this particular time, right? What's the date on this real quick? So this particular time, this is July 5th, 2021. How does Peloton make money? Peloton is based on 3 streams of income. That's the connected fitness products, the apparel, and the subscription revenue. So let me bring this up, make this text a little bit bigger. So fitness products, connected fitness products, apparel, subscription revenue. Okay. So the first one's going to be the Peloton bike. That starting price is $2,200 with an option of monthly payments at $58 a month. So they're making it easier for you if you take it on a payment plan. Okay. So that's a high ticket fitness offer, because to get into it with the bike, you got to pay $2,000. Now we got the Peloton tread, right? That's at $4,000. Right. So these numbers are going to come into play later on in this discussion. So what Peloton is doing is they're really going after a segment of the market that has the money to pay this, or is willing to sink into a monthly payment plan of $58 a month. Right. And I'm not sure they have that for the tread, but they got that for the bike. So that's $4,000 for the bike. And so if you look at their S1 right before I think they IPO'd, 78% of their revenue comes from those 2 products. right? And then they said that they doubling revenues from in 2017, 183 million to 348 in 2018 to 719 in 2019. So their revenues was going up per year in these years before the pandemic. And we're going to kind of talk about that, right? So what happened pre-2020? And then they was getting at a margin around 43% for a physical product, which is a really good margin for a physical product that you got to get manufactured, you got to get it shipped, yada, yada, yada. So one of the reasons why a lot of people were bullish on this company and what the bull case was their margins on the product. We're able to sell this high ticket, right, product to this consumer, get 43%, which is almost half of the cost of it, comes back to us as profit. And then we're also able to sync them into a subscription plan, right? And get more recurring revenue or subscription-based revenue out of this, even though we already on the front end got 43% of this high ticket product in the fitness lane. Now, we also got the apparel, but the apparel accounts for less than 1%. So they were trying to build out their apparel line, right? And then we also got their subscription-based services, which to me was the real business. In my opinion, the real business was not the products. The real business was the subscription service, because that's where the long-term revenue was at. And kind of based on the value and also based on where it's priced, a lot of people is not going to, they're looking at a customer that paid $2,000 up front to get into this particular deal. I don't think they're going to have an issue with the $39 a month. So what you can get with this kind of customer, if you continue to give them value, build community, is you can get a customer that stays in that $39 a month price for years, right? So let's take that 39 multiplied by 12. That's 468. So 468 times 3, 468. Let me bring that back again. We'll take the 468 times 4. That's 1872. So really it's going to take about 5 years at that $39 a month to pretty much equal what you would get from the bike. This is why that bike purchase or that treadmill purchase of almost $4,000 up front was such a good deal, because we get a lot of revenue from this customer on the front end. The question is, and the question I always had is, how many customers are there to buy a bike at $2,000, right? Which is pretty much almost, I want to say 4 years or 5 years at $39 a month at $2,000, and then definitely to buy a treadmill for $4,000. How many people exist in the marketplace to get them ready to buy at that price point, right? And do we have the marketing to continue to persuade and influence people that there's so much value being offered, right? We're such a different company as Peloton that we can continue to deal with this. Because the first thing I'm looking at when I'm looking at these prices is I'm thinking demand wall. I'm thinking once we essentially sell this to everybody that's willing to buy at this price, now what are we going to sell them? Because if we want to expand this company, we got to have something else to sell them. Or we got to create a different category based on price point to go after a different market. And we're going to kind of go into this later in this discussion. But these are the things that are jumping out on the onset, right? I got a fitness-based company, which I know a lot of times fitness is one seasonal. It's also here today, gone tomorrow, trend-based. They're selling a high ticket product on the front end, which is it's really a good thing because we're getting a 43% margin. The problem is if we hit a demand wall, like once everybody buys the bike or everybody buys a treadmill that's going to buy it, how do we continue to expand into different markets? Because we're at these price points, even with having the ability to do monthly payments. That's a long time to pay for that bike at $58 a month or that $2,000 bike. You understand me? These are the kind of things that you want to think about. So this is their business model. It's physical product, it's merch, which is less than 1% at the time that they launched it, and which probably never was going to be big for them compared to because the cost of the merch, and then also the subscription model. So the merch is probably going to always lag because one, it's a one-time purchase, or the merch is not a subscription purchase, and also it's not high ticket. And that's really what I want you to understand. So that's the business model. Now we're going to kind of go into some other parts of this particular discussion.